Welcome to Money Talk with Aaron Ricketts, presented by Ricketts & Associates, 3245 North Adrian Highway, Suite F. The opinions voiced on Money Talk are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, financial, or tax advisor prior to investing. Securities are offered through LPL Financial, member FINRA SIPC. Aaron's in the studios with us here this afternoon. Hey, Aaron.
Hi, John.
Okay.
All right.
What do we got? This turbulent times.
Oh, boy.
Yeah.
So one thing I wanted to make sure people out there, if they are stressed, right, and they're hurting and feeling this market turbulence and the down market, and it's causing a lot of stress. Of course, if you have a financial advisor, you should be talking to your financial advisor. But let me tell you what I do and how I do things to protect, and I say protect. There's no guarantees, but in some fashion protect some money in case we do have these times, which is, it makes my job a lot easier when I tell this story over and over and over and over again. We're going to see good times, we're going to see not so good times, and we're going to see sometimes a sell-off, which is common when there are sell-offs of great magnitude. They're fast, they're hard. That's how bear markets work. That's how these cycles work. It's just fast and hard. It's uncertainty. So I'll give you an example of a client account and the type of client I have, which is often those that have worked their working years, most of their life, and they retire and they got this money in a 401k that we now have in an IRA. And let's say they're taking income, because that's the important part about investing. Of course, your time horizon is important, right? When you're young, you can invest almost, as much as you can, of course, but you can invest as aggressively as your mind can handle it or your stomach can handle it. And then as you get older, you might want to be more conservative because you need to protect more, because you want this money to last at least for, 20, maybe 30, maybe even 40 years in retirement. So we work all that out. And what I do is I identify 24 to 36 months of income. So if somebody is taking income from their retirement plan, I want to set aside 24 to 36 months. So let's say they're taking $1,000 a month and they have a $400,000 balance in their IRA account. They're taking $1,000 a month times 12 is 12,000 times 2 years would be 24,000. I just need to make sure that we got $24,000 set aside to get that person income for 24 months. Because historically, when we have times like these, they rebound within that period of time. There have been an occasion where they've lasted more than 24 months, but usually in that cycle, they come back. And then sometimes, like we've seen in 2018, and then here in 2020, where markets declined very, very fast, and in 2018, they came back very, very fast. So I just need to make sure we have enough money in those safer investments to get people that income that they need. If you're not taking income or you're not near that time you're taking income, you need to let this market do what it's going to do. Keep investing, stay invested, and make sure you're talking with somebody. If you have, if you're paying somebody to advise in your account, you should be getting some advice either through, email, through now we have, social media, to get that information out there, or call your advisor and have that conversation with them. If they're not talking to you, that's the time you start to question, what are they doing and why are they doing it? Because a lot of us might not, I don't get hardly any calls, when the market, like last year was up, 30%. I can't think of one call to say, hey, the market's up. That's real great and exciting. Now, we talk about it during the meetings, but people don't call you because they're not concerned. Now they'll call because they're concerned, and you better be getting a call back, from your advisor. It's extremely important. So I talked about that having enough income set aside in that 24 months. I go 24, 36. Some advisors go up to 5 years. They'll have enough income, especially if you're taking more than, let's say, 5%, 4 or 5% from that account balance per year. You want to make sure that you're in that safety mode and make sure that it's going to last you a long time. What that investment is, typically for me, is a balanced mutual fund that has somewhere between 30 to 40% of that mutual fund in the stock market. So the rest of that money is sitting in bonds and cash. A lot of people, when I talk to them, a lot of people don't know, and I don't expect them to know because, we get a lot of our information from the media. The bond market, the value of the bond market is larger than the stock market. And for some reason, the national media doesn't pick that up as something that is relevant, I guess, unless somebody is stealing money from the bond market. and we've heard of those things happening, but we usually don't hear about it, mainly because the bond market is rather stable. It might go up a few percent every year, or it might go down a few percent every year over a 12-month period or a 24-month period. It doesn't move much. Each bond has what they call a coupon rate. So that coupon rate typically, pays, on a real good quality corporate bond, it might pay 1%. That's it. Some of your other bonds, it might pay 2, 3, 4%, and others that are considered those junk bonds might pay 6, 7%. But the value of the bond itself is fluctuating because it's traded just like a stock. But again, because it's all based on that coupon rate, like an interest rate you might get from your CD or in your checking account, because it's based on that rate, it doesn't fluctuate that much up or down. In 2008, it did. Bonds were down, near 10% in any given time during that year. But this year, just in the last few weeks, bonds, corporate bonds, large corporate bonds have pushed up over 5%. So back to the conversation I was having of how I protect people's money and try to, it's not guaranteed. There's no guarantees on anything if you invest in the bond and stock market, but you can put in some protections such as a balance fund that has 35 to 40% in the stock market. The rest is bonds and cash. So there's not going to be that much fluctuation. However, when we've seen this decline in the market, we've had bonds do the opposite, right? Increase the value. So that's that balance. That's why they call them those things, those balance funds. The balance fund that I use typically is down somewhere less than 5% when the market's down 12 to 15%. I say the market, it's S&P 500, the 500 large companies, or the Dow, which is only 30 companies, but it is an indicator that we see a lot. So you could see if I have taken 10, 12, 24, 36 months of the total value of an account, put it in that type of investment, that person can then receive money from that investment and not worry about anything else that's going on inside that portfolio. Let that portfolio do its job, meaning, ups and downs. I use balance funds in a lot of my portfolios, mainly because there are good quality advisors out there that can get a lot on the upside. So I said the S&P 500 is up over 30%. The balance fund that I use was up over 24% last year. And I say the balance fund that might be 65% in the stock market and then 35% in bonds and cash. They're out there, folks. They're mostly institutional trades, so you can't contact the company and buy them yourself. You have to buy them, through an advisor, or you got to have several $100,000 or $1 million of your own money to invest directly. So they make it, I would say difficult to get to, but you have to go through an advisor. This is the conversation that I have with people every 6 months. That's how often I see everybody. Twice a year or every 6 months, we set an appointment and we go over and over. Back to 2018, we had 3 declines of over 10%. From December 15th to Christmas Eve of 2018. That's not that long ago, but we forget these things. Just in like 7 or 8 trading days, the market declined over 15%, all the way to Christmas. I always remember that because I was in Florida and I was watching this on the news every morning, of course, getting up and trying to enjoy myself, but, had some issues to handle. The day after Christmas, the 26th, the market opened up again. And from the 26th to the end of the year, the 31st, which isn't very many trading days, the market got back over 10%, just in those, let's say, 5 trading days. Amazing, right? The swing that happened, during that time. And so that year, I said there was 3 swings of over 10%, down 10%, and then it went back up and hit new highs. That was in February of 2018, in October of 2018, and again, I said in December, mid-December, late December. So with all that happened, the market ended up, the S&P 500 was down 4.5% that entire year. But think of this. We as humans think of calendars, right? Clocks and calendars. The markets don't think like this. The only reason they think of a clock and a calendar is because we put that in place. Markets open at 10:30 and they close at 4 o'clock. Did I say 10:30? I meant to say 9:30.
Okay.
Maybe it was Eastern Standard Time.
Yeah, right.
They open at 9:30 and they close at 4. Every single day of the week, the work week, and closed on holidays, right? So we put that in place. So it's open and it closes, and whatever it is at the end of the day, that's what it is. So if the market, right, if the calendar would have ended on Christmas, that January 1st was on Christmas Day, we would be showing a 15% decline in all those reports that you see out there in your funds and in the stock market, right? Because the market was down 15% for that year up to Christmas Eve. So just think of that nothing's ever perfect. But that year, it was 4.5%. It was down 4.5%, 2018. Last year, the market was up over 30%. So if you go back 17, 16, 15, for the last 10 years and now in the 11th year, we were bound to see some type of decline. We were going to give back some. Markets don't don't give us a return of 11, 12, 14% annually for 10 or 11 years. Our economy doesn't support that. We have a good economy, but it doesn't support that. So there's no question that we were going to give some of that back. My only concern is if people aren't invested properly, if they don't have protections in place to get their, to get their income for 12, 24, 36 months and get through times like these, that's my concern. Isn't it an easy story? You can hear this when somebody calls me and, they're talking about what we're talking about, this virus and, the slowdown in the economy and the market's declining. And I say, remember our conversation? We have money in this account. Let's go look and see what that return has been over the last, 5, 10 years. Let's look at every single year and let's look at it today. And every single time I can say it's down a third, no more than half of what the S&P 500 or the Dow is. And it always comes back just like the rest of them, and it has been doing that for years. That's what we need out there is that conversation to say, okay, some advisors just use cash. They just put, 12, 24, 36 months in cash. You really have a lot of protection there, a lot of protection. Conversations I have with clients is often they don't want to be out of the market with any of their money, especially if they're taking a lot of income. A lot of people might take a lot of income at the beginning of retirement. They might be delaying Social Security. They might want to do some more things that they haven't done, so they take a little bit more out. We just set that aside and protect it as much as we can.
Well, and I'm sure people are probably wanting to talk. So if they do want to have a chat, how can they do it?
Call me, 265-3540.
All right, Aaron, thanks a lot. We're going to get through this.
We will, all together.
That's Money Talk with Aaron Ricketts, presented by Ricketts Associates, 3245 North Adrian Highway, Suite L. The opinions voiced on Money Talk are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Securities are offered through LPL Financial, member FINRA SIPC. Join us once again next week for Money Talk here on 103.9 WLEN.